Okay, see, in income from salaries, we did basic salary, allowances, and we have just started with Provident Fund, okay? Now see, in Provident Fund, as I said, we have to study three things. First, meaning of Provident Fund, means the concept of Provident Fund, then types. After that, we have to study taxable or exempt, okay? So see here, last lecture I had explained how does a Provident Fund operate. For that, this was a drawing, okay? That from your salary, some portion is deducted and it is set aside in Provident Fund, which is called employee's contribution. And that much amount employer will also contribute from his pocket. That is called employer's contribution. And every year you will get interest on that. Why do you get interest? Because fund money is invested somewhere. And wherever you invested, on that you will get interest. And then one day, all this accumulated amount will be received by the employee. And that day will be either retirement or death, whichever comes first, okay? And this is called lump sum amount received on retirement, okay? Then after this, we have studied three types of Provident Fund: Statutory Provident Fund, Recognized Provident Fund, Unrecognized Provident Fund. Statutory Provident Fund means it is in government service. But in private service, Provident Fund may be there, may not be there. And if it is not there, forget it. And if it is there, it can be RPF or UPF. It is RPF when if the fund money is invested as per government directions. And basically why government wants that fund money should be invested as per their directions, so that staff money is safe. Okay, otherwise government says we are not interested in interfering this private sector people. We are concerned about staff's money. The money should remain safe. That's why we expect that you invest fund money as per our directions. And if you invest as per our directions, the fund will be recognized by government. Otherwise it will be unrecognized Provident Fund. And what difference it makes, you know, if it is a recognized Provident Fund, the income arising from that will become exempt. Although not fully exempt, but it will be exempt. Okay. And if it is unrecognized Provident Fund, it will become fully taxable. Okay. Now see, this much we have done till last lecture. Now, one by one, I will take all Provident Funds with an intention to discuss whether it is taxable or exempt. Okay. So see, I have made three drawings here. First drawing is for Statutory Provident Fund. Okay. And the second drawing is for Recognized Provident Fund. And after some time there is one more drawing. Wait. Unrecognized Provident Fund. This way I will be explaining three drawings. Okay. And now this drawing is made for what purpose? To explain whether taxable or exempt. So see, one by one. First is Statutory Provident Fund. Now, whenever Statutory Provident Fund comes in the question, one thing is for sure, employee is a government employee. Okay. And then in the question, they will give you four things. See, whenever Provident Fund comes, maximum four things will come. What four things? Employees' contribution, employers' interest, and lump sum amount. So now imagine these four things are given in the question, and the Provident Fund is Statutory Provident Fund. So see, one by one the effect of all. First, employees' contribution, if it is given in the question, you will simply ignore it. Means in the statement which you prepare, you will not give the effect of employees' contribution. Why?
It is not our income.
Yes. See, employees' contribution, we don't write in the statement. You know why? Because employees' contribution is what? It is the thing which is deducted from your basic salary. Employees' contribution, how does employee contribute? Does he specially bring some money? It is deducted from his salary. And as you know, last lecture I told you, whenever basic salary something is deducted, we don't write the net amount. We write the gross amount. So imagine when basic salary we have written gross. So employees' contribution is part of that gross basic salary only. So imagine you write basic salary also, and then you pass the entry of employees' contribution also, it will amount to double effect. Okay. So since basic salary we are already made a policy to write a gross amount. So gross amount automatically means from that only employees' contribution is set aside. So it is not a new item, it is a part of basic salary. So if someone says, why do we ignore this? The simple reason is, it is a part of basic salary. And basic salary we always write in the statement and the top of the statement. So we don't have to record this separately. It will amount to double effect. Okay. So see, this is ignore. But tell me, what about employer's contribution and interest? Does it become part of basic salary, or these are different things? These are different, because see, employer's contribution means employer will separately contribute from his pocket. Means your basic salary is different. Plus employer separately contributes from his pocket. So it becomes a new income for the employee. So it will have to be recorded separately in the statement. Even interest becomes a new income for the employee. Although employee is not receiving the interest now. But in your account, if interest is credited, your income is accrued. See, these amounts which are deposited in Provident Fund, you are not receiving now. But once these amounts are credited and deposited in your Provident Fund account, can't we say our income is accrued? And income is taxed on accrual basis, but this will not be taxed. It will be exempt. As we decided earlier, that in statutory Provident Fund, everything will be fully exempt. See, if government wanted to tax this, they would have made taxable. Means this amount only would have become taxable. Even if this amount you have not received now. Are you understanding why I am saying this amount you have not received? See, this is right now deposited in your Provident Fund account. When will you receive? On retirement or death. Right now this amount is simply deposited. But when this amount gets deposited in your account, don't you feel happy? You feel, yes, some income has been earned. Although I have not received, but I have earned the income. But this income is tax free. So see what I have written here, it is fully exempt. Fully exempt. In short, this thing you will not record in the statement because it is automatically included in the basic salary. It is a part of basic salary. But these two things are not part of basic salary. These are separate items. Employer separately contributes for you. Interest is also separately deposited in your account. So these are separate items. So you have to record separately in the statement. Okay. Then this will happen every year. Every year this will be ignored. Every year this will be exempt. Every year this will be exempt. And then after 20-25 years, when employee retires, he will get a lump sum amount. And that time also it will be fully exempt. At that time also it will be fully exempt. Because under statutory Provident Fund, the tax will never come. But see, lump sum amount received will be exempt under section 1011. There is a section for this 1011. Now looking at 1011, you will feel, sir, this section was there somewhere else. It was there in interest on PPF. So even for SPF, the section is same. You know the logic of same section is what? Public Provident Fund is an account for a general public, but it is an account owned by central government. It is maintained by central government. And the statutory Provident Fund is also in government job. So there is some common factor. See, there is a big difference between PPF and SPF. PPF is for general public. Even a child can have a PPF account because that is for general public. But SPF, is it for general public or employees? Employees work under government. So although both are totally different things, but there is a common thing, that whether it is PPF or SPF, it is an account maintained and managed by central government. And since it is government's account, law felt like keeping the same section. Because for the law, it is some government account. PPF is for general public, this is for employees. But since it is a government account, the section is common 1011. Okay. See, people work, he has a doubt that people working in bank, they are government employees. Yes. See, all the banks which you hear as nationalized bank. Nationalized banks means what? Owned by central government. Once we say a bank is nationalized, like Bank of Baroda, State Bank of India, Punjab National Bank, these are called nationalized bank. And nationalized, the meaning of that is what? Owned by government. So all the bank employees are government employees. Okay. So we had a doubt about bank employees. So anyways, where were we? We were at this amount, lump sum amount. This is fully exempt under section 1011. So SPF is over. See, this I had already told you that it is going to be fully exempt. Now I had explained in detail that you will find four amounts in the question: employees contribution, employers contribution, interest, and if the question is on retirement, you will find lump sum amount also. Okay, and this you will ignore, but this you will write in the statement. See, fully exempt means you have to write in the statement, but amount column dash. This also you will record in the statement. In the particulars column you will record interest on SPF, but in the amount column dash. Even this you will record in the statement, but in the amount column dash. But in bracket here you can write exam under section 1011. See, you will have a doubt, sir, why no section over here? See, here also you can say 1011. See, this thing and this thing are same. Why? Tell me at the end what you get. Amount which is deposited, it is the same amount which you get. See, these arrows and this arrow are not same. It is just, this is the sign of your depositing the money in the account. And this is the same amount you are receiving. So technically speaking, if you say, sir, what should be the section of this? You can say 1011 only. But I would prefer not to write 1011 everywhere. For lump sum amount, we will write 1011. And if during this service, employer is contributing, interest is being deposited in your account, just write exam. But still, if someone says, no, sir, some section has to be there, you can say 1011. But actually, I don't want to get confused in multiple items under 1011. You will get confused. So let's make a system. For PPF, we will say 1011, and for lump sum amount, we will say 1011. But still, if someone says, so what about this? So for this also, technically the section is 1011 only, because this is the same amount which has become a lump sum amount at the end. And for that, law has said section is 1011. Okay. So statutory provident fund is done. Now next is what? Recognized provident fund. Now in recognized provident fund, it will be important because this is partly exempt, partly taxable. So partly means you have to understand how much exempt, how much taxable. Obviously some formula, some limits will be there. Okay. So see, even that I will explain with the help of a drawing. Okay. Now, whether the question is on statutory provident fund or recognized provident fund, you will always find four standard items. Literally you should buy at this. Provident fund means you can expect four things: employees contribution, employers contribution, interest, and lump sum amount. But obviously this lump sum amount will come only in a question where employee retires. Okay. See, although you get this on death also, but usually when they make a sum, they don't make a sum of death. Because if employee dies, there will be no income from salary. Then everything will go to the family member, and for family member it will be income from other sources. But the treatment will be same. Whether you wait. All my suspenses. There is some glitch. Wait. Okay. So now recognized provident fund. Even in recognized provident fund, you will find these four items. Okay, so one by one. What about employees contribution? Ignore it. Whenever you see employees contribution, you should feel it is deducted from basic only. And basic we don't write net, we write gross. So this is automatically included in the basic salary. In fact, it is a part of basic salary. So this should not be recorded because we have already recorded basic salary. Then, okay, then look. So employees contribution, but again the same problem. Employees contribution you will ignore, okay. And then employer's contribution interest, this you cannot say you should ignore it because these are not part of basic salary. These are separate items. Okay. This is separate because this is separately contributed by the boss, and this interest you get from wherever the money is invested. Okay. So these are separate items to be separately recorded. But since these are partly exempt, so now you have to understand how much exempt. So see, there is a formula for this. Look. For employer's contribution, there is a formula. It is exempt up to 12% of basic salary plus dearness allowance plus turnover commission. Now you will wonder why it is like this 12% of something something. Because see, in real life, you know what happens? Whenever employer contributes for you in Provident Fund, he will contribute as a percentage of your salary. See, imagine I am a boss and I have got 1 lakh employees. And every employee is of different category. Some employees are of lower category, some employees are of senior position, and some are middle class position. So every employee status is same or different? Different. And I cannot say like this, for every employee I will contribute 1000 rupees. I cannot fix an amount of say 1000 or 10,000. How much I will contribute, that depends upon the status of the employee. And that depends upon employee's salary. So in real life, what happens, you know, whenever employer contributes, he will contribute certain percentage of your salary. It can be 15%, it can be 5% or whatever. But the culture in companies is what, you know, they contribute as a percentage of your salary. But how much percentage, there is no fixed rule for that. That depends upon company to company. For example, if I am your boss, I might decide that whatever is your salary, I will contribute 20% of that in your Provident Fund. So it is my rule 20%. But then what law says? 20% is too much. If employer contributes up to 12%, it is fair enough. It is reasonable. So that much we will exempt also. Because we are also feeling good that employer is contributing for the benefit employee, he should do that. Because after all, it is for employees' old age. And for employees' old age, every company should do this. And whenever government also agrees with some things, they are ready to exempt it. But then government has a limit that if you contribute 20% of their salary, 15% of salary, then sorry, we are not going to exempt it fully. We feel contributing up to 12% is reasonable, and that to 12% of basic dearness allowance turnover commission. Whereas in actual life, I might do like this, I will contribute 20% of your basic only. So what happens in actual life, there is no rule for that. It depends upon company to company. But what a student has to remember, whatever happens in real life, the exemption is 12% of basic salary plus dearness allowance plus turnover commission. Okay, that is the amount of exemption. And then interest. Even for interest, you know, there is a limit. As I said, this is all partly exempt, right? And partly exempt means there will be some limit. So interest also will be partly exempt, and this is exempt up to 9.5%. What is the 9.5%? No, it's the rate of interest. Here you should not say the 9.5% of what? See, this 12% was of basic dearness allowance turnover commission. But the 9.5% which I said right now, it's the rate of interest. Means what law says, if in your Provident Fund, you are getting interest at the rate of 9.5 will exempt, then it is a reasonable rate of interest. But if you are getting interest of 12%, 15% in your Provident Fund, means this is rate of interest, then it will be taxable. Means not fully, partly. Okay. So here it is exempt up to 9.5%. Okay. Then after this, at the end when you get the lump sum amount, it will be fully exempt. Right now, don't say it will be partly exempt, partly taxable, because see, whatever tax government wanted to levy, they were levied at the time of depositing in the Provident Fund. For example, interest, imagine every year you are getting interest of 10%. Every year you are getting interest of 10% on Provident Fund. So out of 10%, you are exempted only 9.5. So balance 0.5% has already been taxed. So obviously at the end when you receive the lump sum amount, it cannot be taxed again. It will amount to double tax. Because see, many students have told me, sir, even this should become partly. Why partly? See, whatever partly taxable government wanted to do, they have already done it during the service. See, this is happening during the service. So that's what I said. Interest, if it was 10%, so 9.5 was exempt, balance 0.5% was taxable, and that was taxable on yearly basis. Every year Provident Fund was credited with interest, and on year to year you might have paid the tax. Now if that accumulated amount you get together at the time of retirement, you will not have to pay the tax again. So in short, lump sum amount will become fully exempt. Lump sum amount will become fully exempt under section 10(12). For SPF it was 10(11) and for RPF it is 10(12). It's fully exempt, okay. Now see, with example, let me explain how to solve this thing, okay. Now, wait. See, this is just a random sum. I have just taken any amount of my choice, okay. This is not a particular question, this is random figures. So let's assume in the question they have given employer's contribution. First, wait. What will you do with employee's contribution?
Ignore.
Don't write only. See, have I written anywhere?
No.
Because my mind knows it is there already in the basic salary. Because employee's contribution is cut from basic only. And this basic salary we have already written at gross figure. So employee's contribution you are not able to see, so you don't have to write only. Then what will you do with employer's contribution? This you will record separately. Because this is a separate thing which employer is contributing for you over and above your salary. So first I will write in the inner column. See, whenever it is exempt, you have to first write it in the inner column. And then what you will do, tell me less.
Yes, exempt under section.
Exempt. See, here again no section. Still if you want to say section, you can say 10, 12. But we have reserved the section for the lump sum amount only, okay. So just write exempt up to 12% of basic salary, dearness allowance and turnover commission. So accordingly, look. This way you will present exempt up to 12%. 12% is fixed. Now this 3 lakhs I am assuming it is the basic salary. This you will be able to find from the question. Every question there will be basic salary. So record the basic salary. And what is this? Dearness allowance. And what is this? Turnover commission. And I have assumed in my question there is no turnover commission. And this is basic. This is DA. So 12% of that 48,000. So minus this balance in the outer column. So nothing new. I am just explaining how to solve in this sum. Okay. Then what will you do with interest? Interest, assume it is given 10%. So it is exempt up to 9.5%. So calculate.
1900.
So how much it comes to? So see, most of the students are telling me 1000. How much? So see, here one common mistake is what you look. Students will take 9.5% of this, which is absolutely wrong. Tell me why this is wrong. See, 9.5% is the rate of interest. See, rate of interest you can apply on the fund balance. But is this Provident Fund balance? See, if I know how much money is there in my Provident Fund, the whole fund balance, then I can understand the fund balance 9.5% is the amount as per 9.5. But this is not the fund balance. 20,000 itself is interest. But this is at the rate of 10%. So if at the rate of 10% interest comes to 20,000, So what will be at the rate of 9.5%? Cross multiply. See, now you can find, but did you understand what mistake is possible? Students, what they will do, they will directly calculate 9.5 on this. And you know why it is wrong? Because you are calculating interest on interest. This 20,000 itself is interest. And on interest, you are calculating again interest. So that is wrong. Rate of interest we apply on the fund balance. And we don't know the fund balance in the question. And you will never know in the question. They will always give you the interest figure. But the given interest figure will be some different rate. So we can use cross multiplication, that if 10% rate gives me interest of 20,000, so what will be the interest at the rate of 9.5%? So that comes to how much? 20,000 multiplied by 9.5 divided by 10. How much?
19,000.
19,000, okay. See, what is the technique to remember this thing, 9.5 cross multiply. Rhyme it. 9.5 cross multiply. 9.5 cross multiply. See, actually there is no need to buy it. If you have understood the concept, you can do. But sometimes in exam, you make silly mistakes. And silly mistake is what? You will calculate 20,000's 9.5%. So it's better you remember only like this. 9.5 cross multiply. It's rhyming. 9.5 cross multiply. And then how to present this thing? This is very simple. If lump sum amount is given in the question, it is fully exempt. You will put directly dash in the outer column because it is fully exempt. Okay. So RPF is also done. Here mainly you have to remember these two formulas. Employer's contribution 12% of basic salary plus Dearness Allowance plus turnover commission. And the logic of 12% is every company in real life what they do. Depending upon your salary, certain percentage they contribute. But that certain percentage can be 15, 14, 5, 6, 10, anything. But law says up to 12% if you are contributing, we will exempt it. But if it is above that, it will be taxable. Tell me, what if employer contributes only 6% of your salary? Then it will be fully exempt. Up to 12% means that is the limit. Anything below that will become fully exempt. So this is RPF. Now one more point, look here. This lump sum amount when you receive from RPF, what did I say? It is fully exempt under section 10(12). But there is a condition. Employee should have rendered minimum 5 years service. Only if employee has rendered minimum 5 years service, then only the lump sum amount will be fully exempt. What is the logic of this? Means law is expecting you serve for minimum 5 years. If you rendered service of minimum 5 years, then whatever lump sum amount you get on retirement or death, it will be completely exempt, provided your work for minimum 5 years. So tell me, what if an employee is retired in 3 years only? He worked for 3 years. After completing 3 years, he retired. Now see, once you retire, you can rightfully say, give my provident fund money. You can go to your boss and say, I am retiring, I don't want to work here. It's my choice. See, no one can force you to work. If you want to leave the job, you can leave. But then after 3 years, you can tell your boss that whatever provident fund money is gathered during this 3 years period, give my money. So boss will not say no. But Income Tax Act will make it taxable. Why? Why Income Tax Act expects that you should work for minimum 5 years? Because see, if employee leaves the job before 5 years, so he will be given this amount, and to give this lump sum amount, all the investments will be broken. And as you know, Provident Fund money in RPF is invested as per government directions. And you know what law feels? Wherever the money is invested, at least it should remain invested for 5 years. And if you break the investment little early, investment will not fetch good returns. Basic idea is what you know, the fund money should remain intact for at least 5 years. But if employee says, no, I want to leave the job in 2 years only. So company cannot say him no. Company will have to say, okay, you want to leave. But since he is leaving, the provident fund money will be broken. Means the money wherever it is invested, that investment will break. And just for giving the money to that retiring employee who is retiring in 2 years, the investment is broken. So government doesn't like it. That's why government is indirectly punishing you. Basically, government is trying to say at least work for 5 years. Because if you work for 5 years, your fund money will remain intact. It is invested in some good areas. Okay. And see, provident fund money, especially in RPF, it is invested as per government's planning. So government wants that wherever the money is invested, as per our planning, it should remain intact. It should not be broken. But now if employee says, I want to leave the job, so we will have to break the investment. That government doesn't like. That's why law is punishing you that if you retire before 5 years, no one can stop you. You will get your money also, but it will not be exempt. But then you know what will happen? It will not be exempt means what? No. If you leave the job after 3 years, say for example 3 years, then you know what will happen? During 3 years, whatever exemption you enjoyed, that exemption will be withdrawn. What did I say? I am assuming employee is left after 3 years. Means 3 years he worked. After 3 years he said, boss, tata, bye bye boss, I am going. Okay. So now he is going. So government is feeling bad. Because after 3 years only you are leaving. So what government will do? Government will say, okay, you leave. But in your 3 years service, every year you got. Firstly, do you understand this exemption you get on year-to-year basis?
Yes.
Because see, this interest is deposited in your account on yearly basis.
Yes.
Employer also contribute on yearly basis. So in your 3 years service, this should have happened 3 times. So in 3 years, whatever exemption you enjoyed, that exemption will be withdrawn. What do you mean by withdraw the exemption? What was exempted will be taxed. So tell me in 3 years, what exemption you enjoyed? 48,000 into 3. Calculate 48,000 into 3.
1,44,000.
See, basically, imagine government is angry and government is saying, what you know, we gave you exemption of 48,000 in first year, second year, third year, now you're leaving, we will withdraw the exemption. Withdraw means they are snatching back. First they generously give the exemption, okay, 48,000 exempt. This way they gave us exemption for 3 years. Now this 3 years total we will be withdrawn back. So what is the total of 3 years? 48,000 into 3? 1,44,000. And 19,000 into 3 years? 57,000. So all this amount will become taxable in the 4th year. 4th year when this statement is prepared, see this statement is prepared every year. So first 3 years your statement looked like this. Then in 4th year what will happen? How will you prepare statement of 4th year? See, it will be like this. 4th year, in this statement of 4th year, that lump sum amount in the outer column, what will come? That 48,000 into 3, 19,000 into 3, that whole amount will come here. And when it comes in the outer column, whatever, how much you got? 2 lakhs? 1,000. It will become taxable. I mean, this way government is retaliating. Okay, government is taking the revenge. Government said, just because it was a recognized provident fund, for 3 years we gave you exemption. 48,000, 48,000, 48,000. See why I am taking 3? Because in my example I am assuming 3 years he worked, then he retired. What if I say he worked only for 2 years and he retired? So he enjoyed exemption for 2 years. So whatever 2 years exemption you got in respect of employer contribution and interest, that exemption will be reversed. Reversed means it was deducted, now it will be added in your income. This is called exemption is withdrawn. Okay. But see, right now you know what you did, 48,000 you multiplied by 3. Every year amount will not be same. Here I assume that all 3 years you got exemption of 48,000 only. But do you think every year it was 48, 48, 48 only? See, every year salary might differ. And if your salary differs, this 12% amount will change. Imagine first year salary was less, second year your salary was more. So every year if the figures change, then this 48,000 will not be 48,000. In real life what we have to do, we have to literally go back in the flashback of past 3 years, and we have to see in the past 3 years statement what was the exemption for employer contribution and what was the exemption for interest. Even interest would have been different every year. See, this year I got interest of 20,000. Does it mean last year also it was 20? Last year I might have got little less interest. Okay. So in short, just to explain, I said just multiply by 3. But actually directly multiplying by 3 is a wrong technique. We have to literally open up the statement of past 3 years. And in each year we have to see what was this amount and what was this amount. This way of all 3 years you have to add up. And then this was earlier minused, now it will be added. And this is technically called exemption is withdrawn. Okay. But this will happen when? If you leave the job before 5 years. Tell me, if you have worked exactly for 5 years, then your exemption will remain alive. Alive means what was exempted will remain exempt. And at the end, whatever you get, it will be tax free. Okay. Tell me, how will you express this thing in a proper language? Because in exam, you have to write the paper in English. Okay. So, listen carefully how I'm saying. Lump sum amount received from RPF is exempt under section 10(12) provided employee has rendered service of minimum 5 years. If he renders a service for a period of less than 5 years, then the exemption allowed in respect of employer's contribution and interest in past shall be withdrawn. I repeat, if the employee renders a service for a period of less than 5 years, repeat, if the employee renders a service for a period of less than 5 years, then exemption allowed in respect of employer's contribution and interest in past shall be withdrawn. Repeat, exemption allowed in respect of employer's contribution and interest shall be withdrawn. And do you agree? Exemption was allowed only for these 2 items. See, employee's contribution becomes taxable as a part of basic only. You were given exemption for employer's contribution interest. That is why my language was, if the employee retires for within a period of less than 5 years, then exemption allowed in respect of employer's contribution and interest in past shall be withdrawn. Shall be withdrawn means what was deducted in past, it will be added. And in my example, it will added in the 4th year, because 3 years are gone. Now in 4th year, when you are talking about leaving the job, so in 4th year, action will be taken of taxing the exemption claimed earlier. Okay. But see, there are certain exceptions for this. Sometimes even if you leave the job before 5 years, government will not retaliate. Government will not get angry. You know when? If employee has to retire due to uncontrollable reason, What do you mean by uncontrollable reason? Maybe employee has become completely handicapped. He has suffered from some severe accident. Now doctors has said you cannot go for a job now. So because of such serious and genuine reason, he has to leave the job, then government will not punish. Okay. And sometimes employee has died only. See, law is expecting you to work for minimum 5 years, but you should be alive. So if death takes place or some serious accident takes place or whatever, due to some reason it is not possible for you to continue the job. See, what should be the exact reason? Law doesn't say. Law says if the reason is not controllable, it is unavoidable, it is so genuine that you cannot continue the job. Then if you have to leave before 5 years, it's okay. It's okay means what? This exemption will not be withdrawn. And whatever lump sum amount you get, it will be tax free. So in my example, after 3 years when he retired, in the 4th year lump sum amount, in the statement you will write dash, fully exempt, because his retirement is due to genuine reason. Okay. This is first exception. If employee retires due to uncontrollable reason. Then if employer's business is discontinued, means the company where you were working, the company is shut down. So employee, even if he wants to work, he cannot work because the company itself is shut down. So this is the second exception. Third exception, if employee retires in say 2-3 years, and if he says, I don't want my provident fund money, transfer it to my new boss. Means imagine employee is changing the job. He was working in Wipro, now he has taken a new job in Infosys. Just an example, till now he was working in Wipro. He worked in Wipro for 3 years. Now he is changing the job. He wants to join the job in Infosys. So employee will tell Wipro that whatever provident fund got accumulated in my 3 years service, I don't want to encash it. I don't want to encash it. Transfer it to Infosys. So if you give such instruction, then also government will not get angry. Why? Because your fund money remains invested. See, if you say, I want my provident fund, give me. If you want to encash, then the provident fund investment will be disturbed. But if you are saying politely that I don't want my provident fund money, I am leaving your job. I hate your company, I don't want to work here. But it's okay, don't give me my provident fund, transfer it to my new company. So if you get your fund transferred to the new job, that means you are not encashing, then also exemption will be allowed. But apart from this 3 exception, if you leave before 5 years, then exemption is withdrawn. You heard there were 3 exceptions?
Yes.
First, employee leaving the job due to uncontrollable reason or ill health. In the law, they have also written ill health or any uncontrollable reason. Means health reasons or any uncontrollable. Second, employer's business is discontinued. Employer's business is discontinued. Third is employee has left the job and joined a new employer with an instruction that his fund balance should be transferred to the new employer. So in these cases, exemption will be kept alive. They will not withdraw the exemption. Okay. See, read this thing. Whatever I explained right now, it is written here. Let us read together. Lump sum amount received from RPF is fully exempt only if the employee has rendered service of at least 5 years. See, at least means either 5 or more. Exact 5 is also covered in at least. Okay. If employee retires before 5 years, then exemption in respect of employer's contribution, remember that 48,000 amount?
Yes.
And interest, remember that 19,000 amount?
Yes.
In past means in 3 years. In our example, 3 years shall be withdrawn. And when we say exemption withdrawn means exemption is reversed. When you get exemption, you are allowed to minus. But now that minus thing will become plus. but it will be plus in that 4th year statement. I am just continuing my example of 3 years he left, okay. So in 4th year it will be added in your income. So that's called exemption is withdrawn, okay. Then exception. However, in following cases exemption will not be withdrawn even if the service is less than 5 years. Case 1, employee has retired due to uncontrollable reasons, example death, etc., ill health, whatever, uncontrollable reason. Then employer's business is discontinued, okay. Then employee has retired and joined a new employer with an instruction that his balance in RPF should be transferred to the new employer. So in this case also exemption will not be withdrawn. But other than these 3 cases, if you have left the job before 5 years, your exemption, exemption will be withdrawn, okay. But see, usually this will not come in the form of sum, because if they give a sum on this, to withdraw the exemption you should know the data of past 3 years. So this is more or less a theory question. This can come as a theory question, means to create a question on this. Imagine, to withdraw the exemption of past, you should be knowing that in past 3 years how the statements were prepared. Like this, see, this is just statement of 1 year. This way you should know in past 3 years how the statement was prepared. All that data should be given, because that only we have to reverse in our current year statement, okay. So this is less expected in the form of a question, but as a theory question they can test you, okay.
What if the company policy says that based on age factor, you will have to provide this much, we will have to render this much service, this much particular time period of
Yes.
service. Then in that case, it will come under case 1 or not?
No, but why employees retiring? That's the question.
Because the policy says that you will have to work for only this much age and this much time.
Then it is a natural retirement.
In that case, if it is earlier than 5 years.
That's okay. See, uncontrollable reason is a broad term. It is not in your hands. It is not out of choice, out of compulsion. Uncontrollable means you cannot control it. Means you don't have a choice to continue the job. Means your boss only has, see in her example, something like this is there, that boss only has put a restriction that you cannot work now. So it becomes an uncontrollable reason. Means you are removed only from the job. Let's take an example. You are removed. So employee will say, I want to continue, but they are not keeping me only. So it's not in my control. So it becomes a uncontrollable reason. See, uncontrollable reason you can put anything. I gave example accident. It can be anything. You are removed only from the job. Now if you are removed, then even if you want, you cannot work. So it is not in your control. So anything can come in uncontrollable reason, okay. Anyways, this is more of a theory question kind of thing. In these sums, when you see employees work for 20 years, 25 years, in the type of sums which we are going to solve, which you have seen in the past paper, they have always given a question of employee working for 20 years, 14 years, 15 years. They have never created a sum where he has worked for less than 5 years. Because if they want to create a sum that employee worked for less than 5 years, they will have to give you the data of past years.
Yes.
What data? That how much exemption you got for employer contribution, how much exemption you got for interest, and that too not just for 1 year, whatever number of years you worked, because that you will have to reverse in our statement, okay. So this is practically not tested in the form of sum, but you should have the knowledge of this, okay. So RPF is over, recognized provident fund. Finally this drawing you have to remember, plus that 5 years point which I said, okay. Last provident fund is what? Unrecognized provident fund, okay. But wait, before that I'll do one thing. I'll take one question of RPF so that this settles completely. Then I will take a new concept of UPF, because UPF is little tricky, little. Take out question number 2. question number 2. Ready? Question number 2. Keep this statement ready. We'll discuss point by point and give the effect simultaneously. Ready? First point is basic salary 22,000 per month. Taxable or exempt? Taxable. But then what did I say last lecture? Basic salary should be written net or gross. But if nothing is given, we have to assume it is gross. So write as it is 22,000 into 12. 22,000 into 12. That comes to 2,64,000. So the multiplication in the bracket 22,000 multiplied by 12. Then DM is Dearness Allowance. Tell me how to decide whether it is taxable or not. Whenever any allowance comes across, you have to search in TC Hut, TC Udhar. If it doesn't fall in TC Hut, TC Udhar, taxable. So this is taxable, 8,000 into 12. So that comes to 96,000. Then
Medical allowance.
medical allowance. Does it come in TC Hut, TC Udhar? Do one thing first, you should underline the word allowance. This is allowance. Only if it is allowance, you have to search in TC Hut, TC Udhar. Everything you cannot search in TC Hut, TC Udhar. But this is allowance. So search in TC Hut, TC Udhar. It's not there, so it is taxable. But then what to do with amount spent?
Ignore.
Amount spent you do ignore. This is given for confusion. You know, when do you need amount spent? When it is TC Udhar. If it is TC Udhar, we want amount spent. But this is not TC Udhar. This is a remaining allowance, fully taxable. I forgot to check your homework today. Suddenly I recalled. Have you done or not?
Yes.
Homework means that writing the notes you have done or not? Then
Employees contribution.
employees contribution to RPF.
Ignore.
Employees contribution, what did I explain? You have to ignore it. Why? Because employees contribution comes from basic only. You know, in real life what should have happened? Employees contribution of 4,000 must have been deducted from that 22,000. An employee in his hand, he should have got only 18,000. How did I get 18? 22 minus 4. Means in real life, an employee got the salary check, he might have got check of only 18,000. Okay. Because 4,000 is Provident Fund deduction. But this 22,000 is before deducting. It is the gross amount. Okay. And whenever problem is silent, you have to assume it is gross only. Tell me, what if this was written like this, 22,000 net? Then that employee's contribution we would have added and made it gross. But in any case, we would not pass a separate entry of that. It should become part of basic only. It should be shown inside the basic only. But here we are not doing, because nothing is given means it's already gross figure. So employees contribution inside that only automatically. Then employer's contribution, this will be recorded separately. Because can you say this comes from basic salary? No, this separately comes from employer's pocket. So it is a new income for you, you will record. How to record? First you will write it in the inner column, then less exempt up to 12% of basic salary, Dearness Allowance, turnover commission. So see, I would suggest you do like this. First write employer's contribution. Wait, I want to show, wait, just a moment, look here. Follow this policy, look. Always make 3 dash like this. And then fill in the blanks. First write employer's contribution to RPF. Wait, you have to also notice it is SPF or RPF. RPF. What if this was SPF? Fully exempt. Then I would have put directly dash in the outer column. You forgot I had explained SPF first today. See this? SPF is fully exempt. Isn't it? But in this question it is not SPF, it is RPF. So 12% of basic plus DA plus turnover commission. Have you shown like this? Basic 2,64,000, DNS allowance is 96,000, turnover commission is not there in the question. Then what about interest? You should remember 9.5 cross multiply. 9.5 cross multiply. So given amount is interest only, but at the rate of 12. But we want interest at the rate of 9.5. So 9.5 cross multiply. Tell me why they have written the word credited. Credited means it is deposited in your account. You will not receive now. See, Provident Fund money, when do you receive? On retirement. And this guy is not retiring. His service is going on. And during this service, when they deposit the money, they say it is credited in your account. Show this way sign of cross multiplication. So 10,800 into 9.5 divided by 12.
Why this interest is taxable in salary? Why not in other sources? Because core activity is doing some of
That point will come in income from other sources. Sorry, UPF. That point will come in UPF. At that time we will discuss on that point. UPF. So minus 8550. Balance outer column 2250. And once all the items are written in this statement, you have to total up. Gross salary 385,050. And after this, you have to always write fixed 3 items: standard deduction, entertainment allowance, profession tax. Whether it is there or not there, you have to write it as a format. Yes, standard deduction will always be there, 50,000. But for entertainment allowance, profession tax, even if you feel it's not there in the question, just write it for the sake of formality, put a dash. In exam, to save the time, you can avoid in exam. But right now, when you are solving this sum in the class, it's better you write.
So we have to write the note for employees' contribution.
That's okay. Even if you don't write, it's okay. And whenever this kind of dilemma is there in exam, see, right now I am guiding you. In exam, if you have a dilemma, just write it. But in exam, you have to also take care of the time factor. Always remember, completion is better than perfection. Sometimes to make your answer perfect and all, your paper remains incomplete. But that is bad. Completion is better than perfection. Done this thing? So question 2 we have done. Okay, then out of the 3 types of provident fund, look, the next one is what? Look, unrecognized provident fund. See, statutory provident fund, it was fully exempt. Recognized provident fund, partly. Unrecognized provident fund is fully taxable. But see, look here. Firstly, why government is taxing unrecognized provident fund? Because these are private sector people and they are investing the fund as per their own wish. And here government is afraid and scared that staff's money is not safe. And they expect that you should invest the money as per government direction. But if you don't invest as per government direction, your fund becomes unrecognized. And the punishment of that is it is fully taxable. But see, look here, look at my action. See, in unrecognized provident fund, when money is accumulated, that time tax is not charged. But at the end, when you receive the lump sum amount, that time it is taxable. It is taxable. But at what time? Not during the service. See what action I am doing, I am actually drawing this thing. This drawing I am trying to show with my hands, okay? See, this is provident fund, this thing, okay? And then this means arrows which are there on the top, and this lump sum amount means like this, okay? So see, in unrecognized provident fund, when money is accumulated during the service, it is not taxed. But one fine day, the accumulated amount will be received by the employee as a lump sum amount. That time it will be taxable. So see, government cannot tax both the time. Can government do like this? That in unrecognized provident fund, when the money is deposited, that time also you pay the tax. and the same money when you receive on retirement, that time also you pay the tax, that will amount to double tax. Tax has to be charged only at one event. So what government has decided? Not to tax during the service, because during the service every year small amount is contributed on yearly basis, so tax will not be that rigorous, and government wants to rigorously tax you, and that is possible if you are taxed at the end on wholesome lump sum amount. Do you agree this lump sum amount will be a big amount?
Yes.
See, yearly contribution maybe say 10,000 and say this is 2,000 something, but at the end you will get say 50 lakhs. And government wants you to tax on lump sum basis. Wait, right now don't see this drawing. This is a drawing of Statutory Provident Fund. Just for the sake of drawing I am showing this. But this is Statutory Provident Fund. For UPF, I have made a separate drawing. Yes, his doubt is there first.
But sir,
It will come. It's going on. Wait. So, what is the rule in unrecognized provident fund? During the serviceman, when money is deposited, no tax. But when the accumulated money comes in the hands of employee at the time of retirement as a lump sum figure, that time it will be taxable. Okay. Now, to understand more in detail, I have taken one example. Let's assume an employee has worked for 20 years service, and the company where he was working there, it was unrecognized provident fund. Okay. And assume every year from his salary 10,000 was cut. Employee's contribution always deducted from his salary, and let's assume every year 10,000 was employee's contribution and the same amount was also contributed by employer. Okay, so can you tell me in 20 years how much amount will be accumulated? 10,000 is per year. Employee contributed 10,000 per year. How many years of service are there? 20. So tell me in 20 years total how much amount was accumulated? 10,000 in a year. So for 20 years it will become 2 lakhs. So from employee side 2 lakhs is contributed in full 20 years period. Similarly from employer side also 2 lakhs. So 2 lakhs and 2 lakhs should be 4 lakhs. But he is receiving 5 lakhs. Obviously because he might have received interest. Okay. Now this amount we ignore. This amount and this amount will be exempt during the service. But now when lump sum amount is received, it will be taxable. As I told you, UPF will be taxed but not during the service. It will be taxed at the time of retirement. But this 5 lakhs you have to divide into 4 parts. Wait. See this. See why this breakup I have done, soon you will understand. For the time being, just understand the data. Then explanation will fall on place. Okay. Now, in my example, I am assuming he has received 5 lakhs. Now, what is the breakup of 5 lakhs, 2 lakhs employee contributed. How did we get 2 lakhs? 10,000 every year. So, for 20 years, it becomes 2 lakhs. So, 2 lakhs employee contributed, 2 lakhs employer contributed. Can you read what is this? Employees contribution. This is employer's contribution. Both contributed 2 lakhs. And on both 2 lakh contribution, there is interest of 50,000. See, in my example, you received 5 lakhs, whereas you contributed 2 plus 2, 4 lakhs only. So, interest was 1 lakh, and half of that pertains to employee savings, and half of that pertains to employer savings. Both used to save together. Some amount was cut from salary of employee, some amount employer was putting, both were contributing equal amount. So whatever interest got accumulated, it equally pertains to both. So What is the wording sir written over here? Just read interest on employees contribution, and this is interest on employers contribution. You know why I have divided this 5 lakhs into 4 parts? Because the treatment of each amount will be different. First check the total 5 lakhs, check the total breakup of this is correctly done. 2 lakhs 50, 2 lakhs 50, total is 5 lakhs. Now out of this 4 amount, this you will ignore. Only this will be taxable, this will be taxable, this will be taxable. But this will not be taxable. You think why? Wait. This is not taxable, but this is taxable, this is taxable, this is taxable. So tell me why this amount is not taxed? Because where did employees' contribution come from? It was deducted from your basic salary, and basic salary on year to year basis it was taxed on gross basis. So in his 20 years service, he might have prepared statement 20 times. See, the statement which you prepare, it is prepared on year to year basis. So in his 20 years service, he might have prepared the statement of salary for 20 times. And in every year, basic salary had come at gross figure. And gross means from that only this is accumulated. So this has already been taxed as a part of basic salary during his 20 years service. So this cannot be taxed again. Okay. Although we say that unrecognized provident fund will be taxable, but not the employee's contribution. Because employee's contribution comes from basic. And basic is independently taxed on gross basis. So this should not be taxed. But this will be taxable, this will be taxable, this will be taxable. Why? Because they were exempt earlier. See, what had happened to employer's contribution? It was fully exempt when? During this service. Every year when employer was contributing, employee was feeling happy, yes, my boss is accumulating something for me. But on that happiness, you didn't pay the tax. It was always fully exempt. Even interest also gets deposited on year to year basis. Even that was exempt. But that was during the service of 20 years. But now it's time to pay tax. So this will be taxable, this will be taxable, this will be. But here one important point to be noted is, read what I have done. This will be taxable as income from other source. Only this too will come in income from salary. Why? See, this is ignored, I have convinced. Okay? And these 3 figures are all taxable. UPF has to be taxable. UPF, last lecture I told you, UPF will become taxable. But then why this is income from other source? Why this is income from salary? Why this is income from salary? See, this is income from other source because this is not thanks to my employer. It is on my personal savings. See, an income is called salary if it is due to my employer, if it is thanks to my employer. But tell me, how did I earn this interest? This is my personal saving. I got my salary cut on yearly basis and my salary was cut and kept aside. It is my salary which generated interest. It's my personal savings interest. See, once you earn salary, it is your property. And if your salary is cut and kept aside, so it is your savings which is generating interest. Imagine if company would not have cut your salary, if they would have given you full salary, and if you would have put in bank, then also you would have earned interest. So this interest is not thanks to my boss, it is my personal interest. Okay, personal in the sense, this is employee's contribution interest, and employee's contribution comes from his own salary, and your own salary, even if you keep it in bank, the interest which you get, that cannot become income from salary. This way what will happen? If you get a salary, you invest, you get dividend, even that will become salary. See, till the time boss has given you salary, it is thank you boss. But after you earn the salary, wherever you invest, it is your personal income. There, boss has not done anything great for you. It is your own income, income from other sources. So this interest is purely on your own savings. But what is this interest? This is thanks to employer. For this interest, you will feel like thanking your employer. Why?
Because it is his.
You feel thankful or not?
Yes.
For this, you will feel thankful or not?
Yes.
Because you will say, you will tell your boss, thank you, boss. Every year you used to contribute 10,000 for me, and because you contributed, on that interest is also come. Thank you, boss. So I will thank my boss for this 2 lakhs also and 50,000 also. And for the amount for which you feel like thankful to boss, it becomes your income from salary. It is thanks to your boss, that's why income from salary. We say it comes out of employer-employee relation. Okay. But this has not come from my boss, this is my personal saving, which even if it was not cut from the salary, even if I would have put somewhere in the bank, I would have independently earned the interest. Okay. So that is why this breakup is done. So see, conclusion is what you know. Look, in unrecognized provident fund, when money is accumulated, it's fully exempt. But at the end, when you get the lump sum amount, thak, 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 4 parts. What is this thak, 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 thak? Employees' contribution, ignore. Interest, income from other sources. Employers' contribution, interest, income from salary. I am drawing the chart. Thak, 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 thak means employees contribution, interest on that. Employers contribution, interest on that. What is the effect? Employees contribution ignore, because that is accumulated from your basic salary, and basic salary has already been taxed. And interest on that is your personal income. It is not thanks to your boss. So it is income from other source. It will be taxable, but it will not be recorded in salary statement. As you know, for 5 heads of income, we prepare 5 separate statement. So this interest will be recorded in income from other source statement. Okay, eventually all the incomes are added. Remember first lecture I told you, at the end all the incomes, whether it is salary, income from house property, income from business, capital gains, income from other sources, eventually everything is added. But during the process of computation, every income should be positioned at a proper place. So this will be positioned in income from other sources. And these two figures will go to income from salary. Okay. See here, you know why did I take the amount? So that you can feel properly. Without amount, I would have explained, it becomes little vague. So finally UPF is also over. Now see, his doubt was, yeah, you asked it up first.
These 4 amounts will be given as it is, or we will have to compute from.
Yes, good question. Look here. Her doubt is what sir, this 4 amounts will be given to us or we will have to find out. They will not give this 4 amount very clearly. Some data they will provide, but not full data. So you will have to use your brains to find out the 4 amounts first. And for that I am taking a question immediately right now. One question I will take, there you will have to intelligently think how to determine these 4 amounts. And once these 4 amounts are calculated, then the work is very simple. What to do? For this you will say, go to hell. This you will say, go to IFS. And for these 2 amounts, come and sit in the statement of salary. These 2 amounts you will have to welcome, because this will come in income from salary. But to find out this 4 amount also, sometimes they play a trick in the question. So you should be able to find out. We'll take a question on that right now. But before that, wait, he had a doubt. His doubt was what See, right now what did I say? This interest, I had given 2 types of interest. First was interest on employees and other was on employer. For employees interest, what did I say? It's income from other source. Okay. So same thing should be done here also. See this. See, I am suddenly going to the drawing of RPF. Okay, because he had a doubt at the time of RPF. So see, tell me this 20,000 interest on RPF, what we do? Exempt up to 9.5%. So actually speaking, even this 1,000, part of it should be taxable under income from other source and part of it should be taxable in income from salary. Because see, whatever interest gets deposited in your account, it is not purely due to employer's contribution. Employee is also contributing. Since both are contributing, so interest is thanks to employees and employers both contribution. But since like in this question we didn't have the data that how much of this interest of 20,000 pertains to employee, how much of that pertains to employer. Since that data is not given, we put everything in salary. But in real life, technically speaking, even this should be apportioned. The portion which pertains to employer should come here. Employer here. And the portion which pertains to employee, it should go to income from other source. Technically. But till now in any questions of ICA, they have not put this point. I had to touch this point because he had a query. He had a query that, sir, actually he had a query while we were solving this question. See this. See here interest was there 10,800. So he had a question that time only, sir, in this interest, some interest is because of employee's own contribution. It's correct. See, 10,800 is the total interest deposited in my account. But in my Provident Fund account, it is not that only employer is putting money, employee is also putting. But since the breakup is usually not given in the question, we don't bother. And you know, in real life doesn't make much difference because in real life, the interest which you get on Provident Fund, it is below 9.5 only. This 12% was unrealistic. No company will have a Provident Fund where you will fetch interest of 12%. Be practical. In reality, you will also work in some company someday. In your Provident Fund also in reality, you will hardly get 8-9% interest. It is always below 9.5. See, in our question, you know, deliberately the percent is a big 12 to test your knowledge. Tell me if it is 12 then only 9.5 exam. To test your knowledge, purposely big rates are given. But let's be practical. In practical life, the rate is always 8-9%, which anyways becomes exam. So there is no botheration to divide this into how much is employees and how much is employer. See, the main discussion I am doing is what, you know, even this interest we should have split into little bit income from other source, little bit income from salary, but don't do that. That data and that information will never be given in the question. So you don't think much in that lines. I am discussing because someone had a doubt. Okay. But yes, when it comes to UPF, in UPF you have to do this interest bifurcation because this is a lump sum amount. It can be in lakhs, crores also. Sometimes an employee might get 50 lakhs from Provident Fund. So it is such a big amount. Okay. So in short, moral is this interest bifurcation should have happened in RPF also, but forget it. Anyways, in RPF, your interest is exempt up to 9.5 and up till 9.5 only you get in real life. Okay. Now see, we will practice this thing with the help of one question. Okay. See, my plan was what, you know, SPF I taught, I didn't take any sum. You don't need any sum because SPF, everything is fully exempt. RPF I taught, I immediately took a sum. Now I taught UPF, I'll immediately take a sum. But before that sum, please listen to one very good thing. Please. 3 Provident Funds, see the way I am summarizing, okay? SPF, RPF, UPF. In SPF, when money is accumulated, that time also exempt. And when you receive, that time also exempt. In RPF, when money is accumulated, partly exempt, partly taxable, but when you receive it's fully exempt, provided 5 years service. In UPF, when money is accumulated, that time it's exempt, but when you receive, it is taxable. Thak, 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 thak.
Yes.
Summary in short.
Yes.
Okay, because see, when a particular theory is going on, it takes little time, but we have to sum up, so you'll feel it is only this much. So if I also ask you a question of provident, you should answer this way only. In SPF, see, when I'm doing this thing means I am drawing this upper arrows, okay? Okay. So in SPF, repeat, in SPF when money is accumulated, that time also exempt, and when you receive lump sum amount, that time also exempt. But in RPF, when money is accumulated, partly exempt, partly taxable. But when you receive at the end lump sum, fully exempt, provided minimum service of 5 years. And here it is exempt under section 10-12. SPF was 10-11, this is 10-12, 11 and 12. But in UPF, when money is accumulated, that time exempt. But at the time of retirement, when you receive the lump sum amount, it will be taxable. How? Thak, 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 thak. 4 parts. Employees' contribution, ignore. Interest, income from other sources. Employer's contribution, interest on that, income from salary. So for this, I'll take a question. Question number 3 it is. Take out question 3. Keep the statement ready. Ready with the statement? Now see one common mistake, you know what will happen here, look. If you try to rush up, what mistake you will do? 12,000 per month basic salary, multiply by 12, 1,44,000. Wrong. Read. Read this carefully. Whenever the question is on retirement, be careful. Don't directly multiply everything by 12 months. See, normally anything given per month we multiply by 12 months because the service is going on throughout the year. But notice in the question, see, he has retired. And that too when? In our previous year. Why I am saying previous year? Income is always calculated for the previous year. And what is our previous year? 23-24. And he has retired in our previous year only. So he didn't work only for 12 months. How will he get salary for 12 months? So see, make a point. Whenever the question is on retirement, look, you should draw a timeline like this. See what I am doing. I'll show you directly which is drawn here. Wait. Like this. Our year is 1st April 23 to 31st March 24. And when did he retire? 30th November. So tell me, he will get salary only for this period. So tell me from April to November, how many months are there? 8 months. So you should be very careful whenever the question is on retirement. It's just a matter of silly mistake I am saying, because usually you have the habit of multiplying by 12. But be careful in such questions. Draw this thing. Make it a rule that whenever the question is on retirement, you will always draw a timeline. Even if you don't feel like drawing, but still you draw. Because if you have that habit, you will avoid the silly mistake. And right here it is 8 months. After retirement, you don't get salary, correct? So only for 8 months. Everything per month only for 8 months. So, okay, read the first line properly. Mr. X retired on 30th November 23 after completing a service of 26 years. Okay. From the following details, calculate taxable salary. So start one by one. First is basic salary, 12,000 into 8. So that comes to 96,000. Okay. 96,000 basic salary. Then next point is dearness allowance, 3,000 per month. Even this will multiply by 8 months. So 3,000 into 8, 24,000. I am not showing the multiplication in the bracket, but you show, huh? Okay, then wait. Now look at this. Look. Tell me the effect of all these 4 points together. You know, actually, these 4 points you should be able to visualize in the form of drawing. Tell me in my drawing how this 4 point will appear. Look, our drawing was like this. Employee contribution, look. Then employer contribution, correct? Then interest. So 3 arrows on the top, then 1 arrow at the bottom, and that is a lump sum amount. And these 4 things are given in the question. So do one thing, don't do anything in fair, do rough work and just draw a rough drawing of this kind of drawing. Do it roughly. And then tell me the effect of all these 4 items. Means I want you to convert these 4 points in the form of a drawing. But see, when you're drawing, keep a margin for this. This will take little space. This lump sum amount. See, in exam, it's not necessary to draw a big drawing. But since we have understood right now with the help of a drawing, it's better for your reference. You should have this kind of drawing in your notebook. Same thing, but amounts you don't put this one. Amounts you put as per our question. See, my drawing is also ready. Is it like this, correct? Employees contribution 2000 per month. See, in the question it is given. Employees contribution 2000 per month, employers contribution 3000 per month. 2000, 3000. Interest 9000. See, what do you mean by this credited? Credited means in your account it is deposited. See, he retired on 30th November, but till 30th November the money was being accumulated only. On 30th November he encashed everything from the fund. Okay, now the challenge is what? How to divide this 6 lakhs into 4 parts. What are the 4 parts? Employees contribution, then interest on that. Employers contribution, interest on that. You should be able to find out on your own. Huh?
The 180 for employee contribution, 230 for employer, and 150 divided by 60,000 is going to equal, and the pending is 90 for
Correct, correct, correct. See, what was the most important information for us? Look this. Lump sum amount of 6 lakhs has got how much interest? Did you read this or not? 1,50,000 is interest. So see, your first bifurcation will be like this. Interest is 1,50,000. So what is the balance? 4,50,000. This I will name it as contribution. Just the word contribution. Now how much is employee? How much is employer? Even in interest, how much is employee? How much is employer? But the main breakup, did you see how I done? From 6 lakhs, they have given interest is 1,50,000. So remaining 4,50,000 becomes the contribution of both employee, employer, both. And then you have to bifurcate how much is employee's contribution, how much is employer. Even in interest, you have to do bifurcation. But in what ratio? Yes, this ratio. Look at this. See, my iPad will get damaged. 2,000, 3,000 will determine the ratio that employee and employer has been contributing in the ratio 2:3. This was most important to be noticed. If employee contributes 2,000, employer is contributing 3,000. So the ratio will be 2:3. So now the thing is very clear. See how I have done? You can continue like this, the way I have done. Did you understand this 1,50,000 was given in the question? And this 4,50,000 becomes a balance figure. And then in 2:3 ratio, Then write below all amounts the effect of that. Employees contribution 1,80,000 ignore. And employer's contribution, it will be income from salary. Even interest on employer's contribution, it will be income from salary. Done? Okay, now tell me the effect of all. See, you have to give the effect of every amount over here. Look, start from the top. What is the effect of this? Ignore. See, you have to talk about all points because see, in the question they had given 2,000, 3,000, 9,000, 6 lakhs. So, effect of all we have to give. So, regarding this, it will be ignored. So, you can write here in the working only, you can write this will be ignored. Okay. And what about employer's amount of 3,000? Exempt. Interest also exempt. Because when money is deposited, that time it's exempt. Taxes at the time of lump sum amount when it is encashed. So see the effect how I have done. Look at the main answer. See this. This dash is for what? This employer's contribution interest. Employee's contribution not even writing, it's ignored. Okay. Then for lump sum amount, see what I have done. Wait. Lump sum amount I have given note 1 here. What is this 2,70,000 and 90? See, out of the 4 amounts, only 2 amounts will come. Employer's contribution and interest on that. So, which was 2,70,000 and 90,000. So, 3,60,000. And I hope you understand this dash is for what? This is for the upper arrows. Arrows which are there on the top. Employer's contribution interest, okay. Because that is automatically covered in lump sum amount. So, this yearly, monthly basis contribution will not be taxed. Yes, you had a doubt? Okay. See here his doubt is what sir, here it is exempt, so why no section? See, UPF is not exempt, it is taxed at a different time. Exempt means what? It will never be taxed. So tell me, would it be right to say this 3,000 and 9,000 will never be taxed? It is exempt for the timing means when it is deposited in your account, that time you don't pay tax. But that deposited money when you get as lump sum, that time it is tax. See, section 10 comes when something is exempt completely, no tax at all. But in my UPF drawing, look here, in my UPF drawing, this exempt means it is not permanently exempt. For the time being, temporarily exempt. When the money goes into the Provident Fund, that time no tax. But the same money when you get as lump sum, it is taxed. So technically it is not an exempt income. The proper term is to say not taxed now. It will not be taxed now. Okay. But that's okay. We can write exempt also. But technically what you should say, this interest and employer, it will not be taxed now. Because right now it is being credited in your account. But when you receive lump sum, at that time it will be taxable. So done. The total of that is gross salary 4,80,000 less deduction under section 16. after you total up the statement, there is some standard procedure you have to do. Against the total, write gross salary, then less deduction under section 16, and write all three items fixed as a rule. Standard deduction, entertainment allowance, profession tax. In that standard deduction amount will always come. $50,000 standard deduction. Entertainment allowance dash, profession tax also dash. I hope you are not biting that ratio should always be 2:3. It depends upon the question. In our question it was 2000, 3000. Sometimes it is same also. So equal ratio. Done. Okay, now look here. Ready everyone? Okay, now see, regarding dearness allowance, there is one point to be explained. See, last lecture what did I say? What is dearness allowance? It is an allowance given to face inflation. Okay, because the inflation is torture. Because in inflation everything becomes costly. So you have to spend a lot and your income is a little bit. So it's very difficult to face inflation. And to face inflation, companies give you dearness allowance. Okay. Now, dearness allowance can be of two types. Sometimes it is called in terms. Sometimes it is called not in terms. Now, what is the difference between in terms, not in terms? That I want to explain. Okay. And sometimes they write like this. Look. DNS allowance forming part of salary, not forming part of salary. So what is the meaning of this? That is my plan to explain right now. Like see, for example, see this question. See here, can you see what is written? Read.
Not forming part of salary.
Not forming part of salary. So if I don't explain the meaning of this, you will feel tortured. Every time it comes in the question, it will irritate you. So it's better to know what is the meaning of forming part of salary, not forming part of salary. It is also sometimes called as in terms, not in terms. So now look here, look. Imagine I am your boss and if I tell you, see you will get a dearness allowance, but it will not fluctuate as per inflation. It will increase as per my terms. Although dearness allowance is meant for inflation, but I am your boss, I am telling you, don't talk about inflation in the market, I will not see inflation. If I want to increase your DA, I will increase as per my wish. Means if your dearness allowance doesn't move as per inflation, it goes as per the terms and condition of the boss. It is called in terms. That means such DA will remain constant irrespective of the inflation. Constant means, see, this arrow indicates what you know. This dearness allowance will remain constant always. Yes, it will increase. But if I want to increase, I am your boss. My terms. Okay. But if I don't want to increase, I will not increase. I can say you are not doing the job properly only. I will not increase your DA. It will remain this much only. You are given 5,000 per month, you will get 5,000. I don't want to increase. You will say, but sir, inflation, to hell with inflation. This DA doesn't go as per inflation, it will go as per my terms. So this is called DA in terms. And why it is called forming part of salary, it is becoming a part of basic salary only. The nature of basic salary, same nature becomes of DA. What is the nature of basic salary? It remains constant. It will increase only when there is a promotion, or if boss wants to increase, looking at your performance, he will increase your basic salary. So dearness allowance will also have the same nature. That's why it's called forming part of salary. And here salary means your basic salary. So see, if boss tells you your DA is a part of basic salary only, means like basic, like DA. So how is basic? It's always constant. It increases if you perform better whenever there is promotion. But let's assume there is no promotion and no better performance. So basic salary is constant. DA also remains constant. So that is called DA in terms. But if I tell you, let's see, your basic salary will be constant, but don't worry about DA. Right now I am giving you 5,000. It can become 10,000 also. It can become 12,000 also if there is inflation. But if the prices go down, I will reduce your DA also. Means your DA will fluctuate according to inflation. See this? I am not dancing. I am just showing the waves in the sense, sometimes it will drop, it will increase, it will drop, it will move according to inflation. Means it will not go as per my terms and my wish. Not in terms. See what I have written here? Not in terms means it will not go as per terms. See, terms means the rules of the boss. So if DA doesn't move as per boss's terms and condition, it moves according to the market, inflation, then it is called, it is not as per terms, it goes as per inflation. So I hope you understand why this drawing. This flat arrow means here dearness allowance will remain constant. Whether there is inflation or deflation, irrespective of the market scenario, your DA will remain constant. Yes, if it wants to increase, it will increase as per the terms. That is why we say it is in terms. And why do you say it is part of salary? Because the nature of DA has become like the nature of basic. So it has become part of basic. Okay. But here it is not in terms, because this DA will not change according to the terms of the boss. It will fluctuate according to inflation. This will fluctuate according to inflation, but it will not move as per the terms. Means even if boss doesn't want to increase your DA, employee can say, sir, as per our rules of job, my DA is not in terms, it goes as per inflation, and there is inflation in the market. And as soon as there is inflation, boss will increase your DA. Okay.
So in terms of amount, it will be already included in the basic salary.
No. In your salary package, see, forming part of salary means in your salary structure, it comes as a separate item. But the nature of that DA becomes like basic. See, forming part of salary doesn't mean it is included in the basic only. Dearness allowance as such is a separate item. But the nature of that doesn't remain unique. It has the same nature as basic salary has. That's why we say it's part of basic salary only. Means part of salary means like basic salary only. But actually when you see your salary slip, the company gives you salary slip or not. In this salary slip you will find a separate item. Basic salary this much, dearness allowance this much. But the nature of that is same as basic. Okay. But then what to do? Now, yes, there are two types of DA. Now what? So see, now most important point, whether DA is given like this or like this, In both case you are receiving, it is taxable. Whether DA you are given like this means constant basis or depending upon inflation. In both the cases it is coming to you or not.
Yes.
So you are receiving as income, so it is taxable. So what difference it makes? The difference comes in the formula. Whichever formula DA has come, it is this type of DA which comes in the formula. Which formula I am talking about? In HRA, remember house rent allowance, the formula was 50% of basic salary plus dearness allowance. But which dearness allowance? This. In all the formulas, wherever DA comes, it should not be this DA. It should be this DA. Why? Because formula is something fixed. Don't we say this is a fixed formula? The nature of formula is fixed, and something which is fixed is made up of something which is fixed. Even in terms has a nature of fixed item.
Yes.
See, this is hyperactive. Which one? That DA. Because it will fluctuate according to inflation. And government doesn't want to make a formula with an item of DA which keeps fluctuating. Formula means something which should remain fixed. And something which is fixed should be made up of something which is fixed. And this is fixed in nature. But this is fixed or fluctuating? Fluctuating. But see, I again repeat, don't think this DA remains constant, it will never change. It will change. But as per the terms of the boss. Say for example, after 5-10 years of service, your performance was so good, I have promoted you in the company. So once you get promotion, your everything will increase, basic DA. So in short, this DA will increase, but not according to inflation. It will increase according to my terms. In short, see, both the DAs are taxable, but in the formula, this is taken, this is not taken. See, there is one good slogan here, read. In terms, in formula. Not in terms, not in formula. It's not tuning. In terms, in formula. Not in terms, not in formula. So as soon as you see in the question, not in terms, not in formula. In terms, in formula. But see, we have solved question till now. See, in this question, DA nothing was given. So we assumed in terms. So see, if you notice in question number 2 which we solved right now, see this. See question number 2 which we solved. See this formula, read. That 12% formula. Which 12%? This one. 12% of basic plus DA plus turnover commission. So now since you know, it should be which type of DA? In terms. But our problem was silent. It simply mentioned DA. So we assumed it in terms. Whenever problem is silent, make positive assumption. This is a very important statement, very helpful. Huh? Whenever problem is silent, make positive assumption. Nothing is given, assume in terms. And in terms, in formula. That's why, see, I took it in the formula. See, I am talking about which formula? There are many formulas which will come. 2 formulas which have come till now is HRA and this one. Till now we have come across 2 formulas where there was DA. This is one, here DA was there. And in yesterday's lecture, wait, that has gone. In yesterday's lecture, we had done HRA. There also, we had talked about Dearness Allowance. So now make it a rule in the whole chapter. Whenever in the formula, if I say DA, so it is understood which DA?
In terms.
In terms. That's why the slogan says in terms, in formula. Not in terms, not in formula. But see, not in terms, not in formula. You have to write it in the main statement. For example, see in this question, in this question, if dearness allowance, they would have written not in terms. You know, many students what they do, not in terms, ignore it. Don't ignore in the main statement. See, in the main statement entry will be passed. You didn't listen what did I say? See, whether you receive DA like this or like this, you are receiving, so it is your income, so it will be taxable. As an item of income, you have to record in the statement. It is just when you are using the formula, that time you use that slogan, in terms, in formula, not in terms, not in, because in formula we take selected things only. We take basic salary, DA, that also in terms, and turnover commission. We don't take everything in the formula. So tell me, if this DA was not in terms, should I write it in the main statement? Yes, obviously. In the main statement, whether it is in terms, not in terms, write it in the statement. Write it in the statement. But in this formula, don't take DA if it is not in terms. If it is in terms, take it. Although in this question the problem was silent, so we had to assume it is in terms. Okay. So these are the two types of DA. I'll do one thing. For both I will write, this is also taxable. Both are taxable in nature. Taxable means both you have to write in the main statement. But this is in terms, it will come in formula also. This is not in terms, not in formula. But both are taxable. Okay. Now see, what is the status of our chapter? Income from salary. Where have we reached? See, this is a checklist. Whenever you finish anything, you have to check what is the status now. So tell me, basic salary is done. Okay, I'll just highlight it. This is finished. Okay, allowance is also done. Okay, provident fund also finally done. Three types of provident fund: SPF, RPF, UPF. Okay. Now next theory comes is gratuity.